Hello, everybody, and welcome. My name is Tim Graham of hotspotting.com.au, and today I'm delighted to be your host for today's webinar, but I'm joined by my brother from another mother, Lucky Velasquez. How are you, brother?
I am well, Tim. I've
That's the
had
way.
the baby. Bit of a full on now, but you're expecting one too? That's exciting.
That's it. So we're a little bit behind you. We've got 9 weeks to go, but as we're talking about offline, I think life's about to change when you've got two.
One is a breeze. Two, I don't know what you're gonna do. But hey, it is what it is.
Lucky you
It's
don't run
all
three
blessings.
businesses or four businesses that you have to run as well.
Yeah, no, 100%, exactly it. So it feels like I've got 7 kids now. But hey, it's a massive blessing, that's for sure. So all the parents listening, we've got love for you. We've got your back, and yeah, give us some tips would be ideal.
That's the way. Well, listen, Lucky, obviously, a lot going on in the finance landscape at the moment. I'm getting asked questions, every day of the week now with, who do I go to as a self-employed
Yeah,
person
yeah.
for the best lending? I'm a first home buyer. I know that there's some great opportunities out there with, deposit schemes and all those types of things, guarantor loans.
Mm.
So I thought, look, with all the things that are changing at the moment, let's get Lucky back on there. Hopefully he's got the answer to that $1 million question as well. When a rate's going to start coming down. So yeah, I thought it'd be a really good opportunity to get you back on because we always learn
I
a lot. And,
appreciate you.
it's yeah, great to have you. So I know you've got a
Thank you so
presentation for
much.
us today. If you want to get that
Mm,
going, while Lucky is getting that up
done, of
and
course.
running, guys, just a little bit of housekeeping. We do aim to be chatting for about 45 minutes today. We will allow for about 15 minutes of Q&A at the end. However, don't leave your questions all to the end. Last time I had Lucky on, we ran a bit late because we had a lot of questions. So if you want to get your questions answered, put them into the Q&A as we go through, and we'll endeavor to get to as many of them today as we can. Lucky,
Cool.
over to you. Let's learn
Thank you.
everything to do with finance in 2024.
And guys as well, like we got a lot of love for the hotspotting community. If, for example, you have some private questions, there's nothing wrong with just hitting me up after this offline. Happy to help out where I can, irrespective if you've got a broker or a banker. I'm happy to put my hand up and just help out where I can. Cool. So, guys, lending landscape. First and foremost, before we start anything, I'd like to put a little PG rating and a little bit disclaimer there. I'll try not to swear. Last time
Last
I
time you
did
got
really
the whole
good.
way through without swearing, Lucky. I was very proud of you.
Tim, that's thank you, man. It's a baby steps for me. But yes, this isn't financial advice. Your circumstance is your own. But if I do swear, I apologize. So again, opinion, not advice. My goal today, though, is going to be kind of for understandings, especially now with the type of people that we are seeing. The policy versus rates. I think it's super important to understand um, why rates sometimes isn't actually your best friend. You need to start looking at policies to kind of maximize, especially your returns on investment. Even first home buyers, people come to us and say, "Hey, look, I just want the cheapest rate." The cheapest rate doesn't usually help you out. And then if they do something on your file, it could burn your credit file. That's not a good thing. So policy versus rates. I'll go through kind of general understanding what policies are and then how you could manipulate it. Yes, I said the word manipulate, and how you could kind of change it. Based on obviously circumstance and how good your broker is. So competitive rates and flexible options. So we'll talk about P&I, IO, understanding what those look like. And the last one I'll talk about is kind of specialized loans. When I'm talking about specialized loans, self-employed, that's a whole topic in itself. SMSFs, kind of some private lending, and just kind of get a general overview on what that is and what that looks like. Now, if you guys don't know me, my bald head, my Malteser head, my cuteness, my brownness. My name is Lucky. I'm the CEO and founder of Finance Better. I've been lending for the last 11, 12, 15 years. Worked in big fours, so I could tell you what they don't want to tell you. And I've worked with the hotspotting crew for a while now. And again, my advice has been pretty opinionated. You'll like me and you'll love me. If you don't like me, you'll never forget me. That's a nice one. But I
I
am
mean,
with Tim's GM.
lucky by name and lucky by nature.
Man, blessed by nature, that is it. And obviously, you guys know my macadamia brother. We got Tim here, GM of Hotspotting. We all know who he is and what he does and what he's done for this community. So thank you, Tim. And you can see a lot of that stuff. If you haven't downloaded the most recent PDFs, please do so. I think the last kind of reports have been phenomenal. Please
Right.
grab that from hotspotting. And again, hopefully in 60 but 45 minutes, I'll try to get this. We got the rock here. You guys can see the rock. I look like the pebble. So this is what we're trying to do. So I'm just trying to put some humor into this. I know I don't want to go through these webinars and it's just boring as crap. So I'm just trying to humanize this conversation. And if you stay to the end, I will tell you guys what we are doing for the hotspotting crew as we do with all the webinars. So again, what that looks like. So we'll discuss kind of crippling debt, loan rejections, reject professionals out there as well, and the kind of missed opportunities. It's really important we talk about that, being obviously a lot of investors are kind of going through here. You're missing out on a lot of opportunities because you're focusing on the wrong thing when it comes to finance. Okay, so let's start this puppy. First and foremost, let's talk about rates and policies. Low rates are tempting, absolutely. It's used as a marketing tool to kind of bring you in, and then that's why at the bottom you have in size 2 font, what the disclaimers are. The LVR has to be at 60%. The debt has to be a certain sum. You have to have a certain income. They won't take certain people, certain postcode restrictions. And then you end up applying, especially if the broker doesn't really know the policies around it, and you're just so focused on the rates that you might end up actually burning your credit files and seeing what that looks like because it's been a decline or an inquiry put on there. And then again, as you guys know, applying for any loans gets hit on your credit file. Not necessarily puts a decline there, but it does affect the credit score. And credit score now, just so you know, can get auto declines. Yeah, auto declines. So
That's an interesting one. So even though it might not actually get declined, the more loans that you're applying for obviously says that you're trying to get more credit, and it can obviously affect you in a negative way.
100%. It goes it's same thing. Like we've had a couple of clients where they've applied for especially first time buyers. They've applied for kind of 2 banks prior to, right? They've done kind of some pre-approvals, didn't kind of get didn't pull the trigger on them. Their credit score effectively kind of went lower to what the bank was focusing on. Auto decline straight away, right? Now, auto decline before, you could usually go back to the BDM or the bank and say, hey guys, pick up my file manually. That's very rare now. Once an auto decline has hit, that lender or that bank usually will come back and say, we don't want to deal with that person anymore, and that's not a good thing. And then you have to workshop it again, and then et cetera, et cetera. Yeah. So again, common misconception about low rates, and I'll talk about kind of like initial benefits and versus low term cost. But yes, low rates are awesome. Tim, you've been poached, I'm sure, by some advertising online or some marketing gimmicks, and you're like, wow, this is fantastic, like an incredibly low rate, and I'll just go there. But we need to understand it's not the right choice, especially for your situation. We need to understand what that looks like and understand what it looks like from a long-term point of view. What are the steps on the second and third thing you decide to do? Especially for our investors out there. If you're deciding to buy one investment property and you decide to buy 5 or 6 behind them, yeah, it's based on the lending that you do up front, right? And if you don't structure for your 5 or 6 purchase, you might be burning the opportunity to then do that, right?
Give us an example of how that could work, Lucky. What does that exactly mean?
Like, I'll give an example. So let's say you end up going to 1 or 2 lenders because you're fairly comfortable with the rate there, and you decide, you go, okay, cool, I want to purchase multiple. Actually, I'll go into an actual scenario that I dealt with. Yeah, self-employed applicant who's just like, hey, you know what, I just want to do I'm thinking about just refinancing my property now. Went to a lender just because of rate. We kept having the conversation. I'm just like, man, we shouldn't be going here just because of rate. We shouldn't be going here, et cetera, et cetera, et cetera. End up going to that lender because of the rate. A week after the loan settled, they came back to us and said, hey, actually, we decided to buy 3rd, 4th, 5th, 6th property. And we're like, man, if we knew that earlier on, we could have structured the first lend to then maximize the cash out, right? And then that then allowed you to then purchase multiple. So now we've got to refinance that away again from that lender, do the cash out, exhaust some policies, then do this the 2nd, 3rd, 4th, 5th purchase. So if you decide to do a future thing, make sure you understand that planning is for now, right? And rates are usually tempted at immediate gratification. Yeah, it is the rate now. And it's like, yeah, cool. it's not going to be what it looks like from a structure point of view. Just so you guys are clear.
Yep.
And again, there's a lot of hidden power and policies. These are the some interesting ones that we've got as of late. ANZ, you guys can go up to 97% to established property. So established property only. You guys could go 97% LVR. I think that's fantastic, by the way. We've got Mortgage Mart. You guys can go up to 98, so 99% of investment construction. Previously, there was kind of no construction that can go up to that LVR. So Mortgage Mart is a mortgage manager. Bank West, by the way, does the same thing now too. So
Right.
Bank West can go 95%, I'm sure, on construction as well, on investment. There was no option for that at all before.
Just on
Before it
that
was just
subject,
existing.
Lucky, I
Tell me.
mean, I typically look at, LVR is really a bit of a reflection of banks' appetite for risk as well. If they're willing to go
Yeah.
that high, that's a really interesting sign for the new build industry. I think,
Yeah.
if we look at the struggles that they've had over the last couple of years, you would think with the amount of due diligence the banks are doing, if they're offering, LVRs that high, they're pretty convinced that, a lot of those bigger problems are already out of the way. Would that be an accurate assumption?
Yeah, absolutely. Like most of these lenders understand what the risk appetite looks like. Like they are getting some confidence, in that certain section or that certain sector. And again, even when we look for great investment properties, we look at the postcodes to see what the restrictions are from a lending point of view. So yes, it just shows that there's strength in the investor market. Excuse
Mm.
me. There's strength in the investment market. There's also strength into that risk appetite. But we could also kind of revert it back to, what is the growing trend? It looks like a lot more people now are going into acquiring investment properties, looking at versus going into first home. So we're seeing a lot of that segment kind of come through. So yes, one fact is commercial, where the banks are saying, yes, I want to acquire the book. But a lot of it has gone to a heightened risk appetite or an understanding of risk appetite, because they understand that yes, it's something that we want to kind of go into. I think it's pretty cool.
Yeah.
And you're going to see that general trend happen now. There's been a lot more policies regarding looser investment policies too, which I think is pretty cool.
Just quickly,
Wave,
before
yeah, tell
we
me.
change that, we have got a question which I will
Oh yeah.
ask now because it's
Ooh.
timely. So on the screen at the moment, you're showing DTI of less than 6, so debt to income ratio of 6. Could you explain what that means? We've got a question from Steve.
Yes, sweet. So DTI effectively is just the times of how much income you are that you could borrow. That's it.
Yep.
So six times what that income is, including and when you say income, it's all income, not just yours. So
Yep.
100 again times 6, but then you got to understand the factors of also expenses too. So there's it's not a true cut understanding what a DTI is, just so we're clear. In the general rule of thumb of the policy of what it looks like from an understanding, DTI is just times 6 of income. However, in servicing calculators with banks, it does take certain other metrics too, like expenses and other incomes where it could take it from, like potential rental income, the shading of rental income. So when
And
a
how does
bank
that
usually just
differ from,
says
say, DSR, debt to service ratio?
it's similar, right? But the thing is, each bank, even if I gave you the definition of DCI, DSR, those are gray areas because banks assume different things.
Yeah.
And
Okay.
and that's what's difficult in understanding policy or rates. They say DTI of less than 6 or DSR of whatever the case may be. But then when you go into actually submitting the loan, they give you a completely different answer because the servicing is completely different. So
Yeah.
there's no true answer what to that look like. There's a textbook answer, right?
Yeah.
And I think that's a great, what's the name of the question? What's his
Steve's
name?
asked the question.
Steve,
He
well
also
done.
wanted to know what OFI debts are as well.
So OFI debts is your current debt sitting outside. So if, for example, let's say you got a main debt refinance or the main debt that you're trying to go inside the bank to. OFI debt is basically any loans outside that sit that has to be added for servicing that's not included in the application in itself. So let's say you're refinancing a home loan of 550,000 or purchasing a 550 debt. OFI debts is the debt sitting outside that you have to add as part of liabilities. Now, I'm going to go into OFI debts in a minute. OFI debts is really, really important because that could make or break your borrowing capacity. If, for example, a lender looks at OFI debts, sometimes they'll put a buffer of those OFI debts on, and some of it they won't. And I'll give you an example of what that looks like. Bankwest right now they are rewarding 12 months good conduct on investment refinances. Before they would put 3% buffers and then 3% buffers on OFI debts. Now they're
Geez,
only putting 1%.
That's a game changer.
It is actually that's actually very, very recent. So
Mm.
actually that was like last week.
Oh,
Um,
wow. Wait a
so
second. Are you telling
that's
me that
interesting.
there's a bank out there that is actually going to look after their existing customers? I thought
Ah, yeah.
I thought they only looked
Look at
after new
that.
customers.
No, 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 no. They could do that too. Yeah, yeah. And
Hey.
by the way, guys, just so you guys know, for the people that's listening out, go to your bank and then ask them 2 questions. This is something that I'm going to talk about later since we're on the topic. Fantastic. You're getting my juices going. Ask them if you are front book or back book.
Mm,
Okay. Write that down. If you guys listening, ask if you are front book or back book. Front book is advertised cost. Back book is their profitability margins.
mm,
So if you ask for front book rates, best thing to do, you get the front book rates. Back book rates, you stay what it is. You make good profits for the bank. So
mm.
just a heads up.
Okay.
Couple more things. Wave money, pretty interesting. They could accept housemates as rental income. So if a housemate is renting $200-300 a week on one of the rooms, you could take that as part of income. I think that's fantastic. And the last one is Liberty. Look, Liberty, again, we use Liberty quite a lot for our investors, but there is no buffer for OFI there, so they'll take the actual repayments, and that
Mm.
is a big thing. So pretty cool. Policies, and well done with the questions, by the way, guys. I think just keep putting it through.
Yeah,
My
it's
my
good.
juices start to flow a little bit more better. Again, policy is the backbone of everything, and it could make or break your property portfolio. So, and we need to consider these situations: one with low rate but terrible policies, and then with high rate with strong policies. I know the obvious answer here is but lucky. I'm just going to go with the low rate, but poor policy. Again, look at the holistic thing of what you're trying to achieve, right? Especially if there's a timing issue. There's one lender I'm not going to talk about, but there's one lender that has relatively low rates, but to get an answer is like 6-7 weeks, right? By the
Yeah.
time you get the actual rate and settle, you'll be on the same rate that everyone else is on anyway. So
Mm.
there's just no
Oh,
point in
not to
trying to do
mention
that.
that if it's for a purchase or something, you're not going to be able to
100%.
get the finance settled in time.
Yeah, and I think Tim, like, let's talk about this for a minute, right? For the people that can't see this webinar, a home loan or an investment loan, you're not married to it. You could say it's for 30 years, but you're not married to it. You know, effectively, you're engaged. You're engaged with the circumstance, right?
Mm.
So if the circumstance gets you into this, what it could change in the future. Something
Yeah.
may change in the future where you might liquidate from that security and then use that other money to then buy whatever, refinance to a different lender, so on and so forth. But we need to understand that by getting into it, it's not forever.
I think
Yet
it's a really
you're
good point,
engaged to
Lucky.
the
And
circumstance.
we quite often talk to investors about interest only loans on investment properties, and for a lot of people, they feel like, well, I'm never going to pay this property off. But it's really important that we focus our attention on paying down the owner occupier debt first.
Mhm.
So it doesn't matter if you've got investment property debts that are on 30 years and you keep on refinancing back to 30, as long
Yeah.
as your extra cash flow is paying down the owner occupier debt, there's no issue with that. So I think interest only loans, certainly, 3-5 year opportunities are really worth considering.
Yeah, I get that a lot. I get it heaps of times when they're like, "Oh, I don't want to do IO for now." And look, I guess like I got to listen to him and understand what that looks like. But my 2 cents around that is, especially if you have multiple investment securities, then you could really understand from a cash flow perspective what it is. And you have a non-taxable debt, like an owner-occupied debt, the focus should be principal and interest on that. That should be the main focus, versus trying to pay down a tax gearing
Yeah. I think
asset.
when people sort of, if you're looking linear across a page on how much you owe on each property, you don't like to see any loans not going down. But if you
Makes
put
sense.
$200 of your cash off any loan, it's still $200 off the portfolio. You can choose to pay it off the investment property, which is no real benefit to you, especially from a tax perspective, or you put that same one into your owner occupier, which is reducing your bad debt, which is obviously going to free up more equity for you and servicing in the future. So I think that's
Mhm.
the main hurdle a lot of people struggle to get
Sure,
past.
100%. So the kind of expert tips regarding prioritizing policies, I'll just kind of go into these 3 bullet points before I go to the next component. But excuse me, identifying key policies, like that's super important. I talked earlier on about manipulating policies. Policies is not Bible neither. right? So what I'm saying by not Bible, if your circumstance is good and your broker or your bank is good at sales, right? You can sell the situation or the scenario to credit, of which credit could do an off exception, or they could do exceptions or off policy understanding, depending on what the whole situation is.
Yeah.
So we have been in multiple circumstances. We went to a certain lender because we had to go there. The policy is definitely, it's clear guideline that it is a no. We then understood what that looks like, and then we sold it. We put it in a bow and said, look at it for its merits, and then you can get deals across that way.
Yeah.
It is the only thing about that, though, and a big caveat to that, though, is please make sure, please make sure, if you guys are going around negotiating better policies, do that prior to sending the application over to the bank.
Mm.
Please. And the reason why I'm saying that is because if you send an application through the bank and credit has touched it, they will base it based on the current merits that it's in versus pitching it to them as a deal prior to submitting that application. And then they go, oh, wow, cool. Then we'll take it. Then we'll consider it. Fantastic. Then you submit it. Yeah. That's the best way to then do it. You don't burn your credit file. And then usually you could have offline discussions even before you submit the deal.
Well, that's what
Really
that's
good.
one of the big benefits of going via a broker who can speak to the bank's BDM prior to lodgement.
100%. And
Yeah.
especially if you've got a BDM that understands credit and the broker knows credit, it's magic happens.
Mm.
That's usually how it happens. And again, avoiding common policy pitfalls and common policy pitfalls is truly not understanding, what you're doing. If the broker doesn't understand what they're doing, you get, it's very early on that that's the case. And it's nice to be educated regarding policy too. The reason why it's nice to be educated regarding policy is because in the future, you could have a really nice, meaningful conversation with your broker or your banker saying, actually, one of my in policies before was this, like, is this something you would consider? And that's policies. So that's what I would understand. And again, I talk about focusing policy more than focusing on rates, because rates is rates, like, up, down, that's just the way we see it. So and again, complex lending policies requires a keen eye for detail, and that's especially, I'm talking about for self-employed, I'm talking about for SMSF, I'm talking about for investors now, I would see as complex in a lot of ways, because it does need a fair level of planning, a fair level of understanding, before you even start diving into just an
Well, I think
application.
the higher interest rate environment we're in, anybody who's already got 1, 2, 3 properties is finding it tougher to find
Yeah,
investment loans. So going to a broker who knows where the policies might be more suitable would be. I mean, right now I know there's a lot of lenders out there that might not take into account, a full amount of rent if you're a 50% owner, as an example. Some lenders will.
yeah.
There's policies like that that can be a complete game changer for you in an environment like this.
I'll give you a perfect example. Actually, you reminded me of a scenario. There was a scenario, actually, it was a hotspotting member. They came to us from the last webinar, or the first webinar that we did. They went to two brokers, they went to a bank. They couldn't get the lending to what it needs to an acquire property. The property, I think, was like 320 grand. It wasn't too intense,
Mm.
right? Yield was fantastic, but they were just like the property goal was just about yield and cash flow,
Mm.
because they had some capital growth properties. And they just couldn't get the lending that they needed to. So we had to go through a non-bank lender. We had to pitch it multiple times, get the merits together. They got approved. Then they end up acquiring that probably that security.
Mm.
And this is the stuff that we kind of talk about. Like, there are some brokers that are good at owner occupied, nothing wrong with that. There's some good brokers that are good at commercial, and there's others that really understand policy and squeezes that for every single juice that it has.
Mm.
And a lot of investors need to take advantage of what that looks like. And more, even going to the bank, nothing wrong with the bank, but even go directly with the bank, they won't tell you if another bank is better for them. They won't tell you if another one is
Yeah, of
structured
course.
well. They just won't tell you.
Yeah.
I went to my bank. They're just like, hey man, I want to buy my 7th one. They're like, what? I was like, okay, cool. So let's talk about some competitive rates. I'll talk about P&I, IO, and a comparison. And this, guys, is just a general understanding of what that looks like, because for the most part here, I don't know people's incomes or debt levels, but just to kind of give an understanding. But before I go into this, my friends, my family. I will say one thing: rates across the board is neither here nor there, right? So, it's very rare that you'll get something in the fives now. If you are, good for you, but it's very rare that we're seeing that now. We're seeing people in the sixes, and that's usually what it looks like from what it is. So
Mhm.
we know what principal and interest loans are. I'll just kind of understand what that looks like. Principal and interest is paying down the principal and interest, so the interest as well as paying down the debt that you have borrowed from the bank. That's what principal and interest is, in a nice, beautiful way to say it. And just a side note, because everyone's so focused regarding offset, this is just a side topic, Tim, but we'll talk about this in
Mhm.
another topic. Everyone goes, well, I put my money on an offset account. Why am I making the same repayments? Great question. You're
Mhm.
making the same repayments because it's still calculated as principal and interest over that term. That's it. The only thing like, think of it like this: you got $1 coin. 50% of that goes to interest, 50% of that goes to principal. When you put money inside the offset account, 60% of that or 70% of that goes to interest. The remaining goes to principal. You're still paying $1. Make sense?
Yeah.
So that's just the way to do it. So if you're putting money in the offset account, you're still making the exact same repayments on the loan contract. Nothing changes. Yeah. Interest only, different. Interest only is, again, only paying the interest. You're not paying the principal. And interest only is a credit decision. Credit decision now. Before, like 7, 8, 9 years ago, we used to go to the bank and give them a form. Hey guys, I want to change my thing to my loan to an IO. You just fill out a form, away you go. When you do
Mm.
interest only now, it is credit critical. And credit critical basically means you have to apply for everything. You have to give new pay slips, new self-employed stuff, and they're going to make the assessment if you could still make interest only. So
It's
if
basically applying for a whole new loan.
it is applying for a whole new loan, which goes to my second understanding. If, for example, you're 4 year or you're 5 years, things has happened in your life or your portfolio that you wanted to change, and because you wanted to change them, is it still worthwhile to be at that bank? If you're going to apply for, if you're going to send the same documentation that you're going to the same bank on, and another bank is doing it better, that's going to be better for your portfolio, rate or policy, go to that bank and do interest only there, because you're going to provide the same documents anyway.
Mm.
That's what's called credit critical for IO, for my interest only family.
Mm.
Now, I want to use the same example regarding the offset account. If, for example, your debt's 200,000, you got 100 grand inside your offset account and it's interest only, then yes, your repayment is 100 grand, right? It actually takes the actual balance after your offset account, doing that it's interest only because there's no principal. And
Mhm.
that's where a lot of people, even my most vivid investors, they still get confused. They're like, how come my repayment
Yeah.
is high? I put all my money in the offset account. It's not connected properly. It
Yeah.
is. It's
That makes
just
sense.
a different product. All right, cool. So here is some interesting one. I'll just do kind of like top 5 that we have seen,
Mhm.
and yeah, I'll go top 5. So ING 6.44 interest only. We got AMP 6.59, and then we got Bounce, My State, Macquarie, and Bank West, kind of 6.64, 6.65, and 6.69.
Mm.
Now, right, you may be asking me, you're like, well, Lucky, let's just go to the cheapest one. All right, cool. The cheapest one here, 6.44, no problems. On this on this example. But the best policy in here is actually the one that is 4 basis points higher than everyone else. Yeah. Just to give you an example, the cheapest one here, like, I'm not going to say that. I'm going to say it. ING, cheapest here. I was like, oh, you know what? Stuff this. ING from on this page is the cheapest one. The best policy that we've experienced from an investor has been Bank West. Yeah. If you're a property investor, if you go with, say, Bank West as an example, depending on your situation, and if you even pass that policy, you could buy 2 or 3 investment properties. ING, you could get the refinance done. If you're an investor, what would you do? Go for rate, go for policy. Perfect example.
Yeah.
Perfect example of what that looks like. And their cash out policy is fantastic. And by the way, we're not skewed to talk about specific lenders, guys. This is just what it is from our experience at the moment.
Yep.
Again, principal and interest here, it ranges from 6.29 all the way to kind of 6.49. If you're in that vicinity, it's a decent rate. So the statement here is, again, ask them, am I front book or back book, best way to negotiate your rate. If you still, if and sometimes, especially some big four, working at a big four before, they'll tell you it is front book rates, but you're not getting front book rates. You're still back book. It doesn't matter how much you push, how long you've been loyal to them, you still won't get front book rates as a heads up more than anything else.
Mm.
So again, I'll talk about some why interest only loans. So lower monthly payments during introductory periods, and again, it gives borrowers more time to save before having to pay down the principal. But the cons with that is obviously after the fixed period, you might have to, put a credit. It is credit critical, so you have to put your like your justification on why it should be interest only again. And again, you could understand that, if for example something was to happen and it goes back and it has to go P&I, you might have to offload that investment property, or understanding what your accountant planning may look like if you decide to make a higher repayment on that.
Just on that, Lucky, I think it's
Tell me.
a really good point to bring up is, whilst we might be nearing the top of the sort of interest rate rises, for those that were entering into loans a couple of years ago when loans were as low as or interest rates were as low as they were, people that maxed out their budget at that time,
Mm,
after we saw interest rate increases, obviously their borrowing capacity dropped away. And this is why they were talking about, the mortgage cliff and things like that, trying
of course.
to go from an interest only loan that's chipping into P&I and having to go and
Mm,
refinance elsewhere became very difficult for a lot of people. So
absolutely.
what Lucky's talking about here is that you need to be considering a couple of years ahead. And that's where the benefit of having a broker can really help you, because otherwise you can easily be attracted to, the shiny bells and whistles and the
Rate
low
syndrome.
interest rates,
Yeah,
and all
yeah,
of a sudden you're in trouble. Now, quickly,
yeah.
Lucky, the other thing
Tell me.
we didn't touch on there, what's happening with fixed rates?
Oh man, what's happening with fixed rates?
Well, I mean,
What do you want to
obviously,
know?
you're taking a bit of a gamble anytime you're looking at fixed rates, but what sort of rates are
Oh,
we seeing in fixed rates at the moment?
look, we're kind of seeing the same. Like, it's not that far away from variables. Like, and I'll tell you one more thing. For me, and guy, I'm talking as family, yeah.
Mm,
Like the people that's listening, I'm just talking as family. This is opinion. Usually, when we see rate rises, fixed rates, we get this email, and the bank would usually say, "Hey guys, our fixed rate has increased." It's usually a tell sign that rates that the cost of borrowing from the lender point of view is probably going to increase a little bit more, and therefore they've increased that fixed rates. So when we start to get a little bit uneasy when rates start to increase, when fixed rates start to increase. Now, have we seen that as of late? We saw the most recent inflation numbers. Some lenders have increased the fixed rates. Some,
mm.
which is then very interesting. I was going to leave that till the very last conversation as just part of Q&A and conversation. But we're seeing some fixed rates increase, which is interesting. Are we seeing another RBA rate rise?
Maybe.
Before I was like, I don't know, maybe, but it's not off the books yet. Yeah,
Well,
so
one of the big
you know,
challenges that we've got is with these, new tax cuts. If that actually does end up going back into the pockets of JB Hi-Fi and the likes, then it's
mm,
very likely that we'll see inflation increase again, and that could be spelling disaster for us in terms of
yeah,
rates again.
100%. Mind you, though, the inflation numbers has just come from end of financial year. Everyone's spending their money
Yeah.
anyway. A lot of businesses are spending it. So, and they have to do it from a tax point of view, which makes sense. End of
Well,
financial
I
year.
mean, the US has started to get it under control, so hopefully we follow suit there.
Yeah, yeah, absolutely. Yeah, so interesting. Fixed rate again, pretty similar in that, depending on your situation. A lot of our investors usually have a mixture between fixed rates and variable, where they do like fixed rates on, maybe say 2 or 3 years on the current debt. Decide to leave that interest only, and then have like a variable or a floating a sub account for their cash outs, etc.
Yeah.
Which is a nice segue into cash outs. So
Well, AKA
tell me.
equity release.
Equity release. That's right. It's called equity release, cash out, using the equity inside your account, whatever you want to
Line of
call it.
credit.
But line of credit.
Yeah.
Oh, maybe not, but like actual just cash out. So
Mm.
I'll talk about this for a minute, because a lot of people that do want to take cash outs from their current equity position, and that's really important. So cash outs involve, again, borrowing against the equity of your home. Yeah. Some lenders can go 80%. Some lenders can go 90%. Yeah. So just a heads up. So for the people that go, hey, I want to take cash out, but or and my investment hasn't grown to an area where it's at 80%. There's some lenders that can cash out up to 90% or 88 plus LMI. So that's what it is. Now, the purpose of cash out is very interesting. Yeah. Cash out's it's just a very loose statement. For the most part, our investors here use cash outs to acquire another investment asset. But a lot of people as well cash out for the purpose of buying businesses, for the purpose of, buying personal stuff, cars, whatever the case may be, and just take advantage of equity position. So we need to understand the flexibility of lenders and what that looks like. So I'll talk about flexibility of lenders. I'll talk about lender stances on cash outs, flexible versus restrictive, what to look out for, very important. And then case studies of successful cash outs. So super, super important we go through there. Cool. So again, cash outs could be a super powerful tool. It allows you the money to then acquire what you need to acquire without having to go to your bank and saying, can I use my own money? So cash out, it just says there, it's open. You could use it when you want to. Now I'll talk about some interesting policies again with some cash outs. I think this is pretty cool. And what we look out for, especially as a broker. As brokers, or depending on your situation, we want to look out for cash outs that are what's called uncontrolled. Yeah. Uncontrolled cash outs is basically when a bank has said, here's $1 million. I trust you. That's what we're looking for. Yeah. Which is called uncontrolled cash outs. A perfect lender that does uncontrolled cash out, Bankwest, even NAB has been really good for a cash out. They go up to 80%. Bankwest does it. No questions asked on single security. So they're like, yeah, cool. Let's say that you've got 90 cents owing on your property. And you wanted to take out $1 million because you wanted to, you could do that. Again, perfect policy. What about if it's $1.1 million, Lucky? What can I do there? Perfect. It's not in policy. We ask for an exception. We get the exception. We apply. We get the $1.1 million. Yeah. A perfect example of policy Bible versus policy that you could pitch the bank for. But that's an important thing. And another one is, so that's uncontrolled. The restrictive cash out is the one that we don't usually like to go to because there's so much control in that. And that's difficult, especially for an investor. Perfect example of what that looks like, right? When let's say, initially the application says, I'm going to buy a property at $300,000. Let's just say I took out, some money to then do that. This is the yield I'm expecting. This is what it is. The bank approves you. They hold the cash. When you find that property, at times you actually have to then go back to the bank, pitch them why you need the cash out again. And they go, nah.
This is the difference. It's really comes down
to
to the difference between them approving it based on your intention, as opposed to saying, "Hey, I'd like to buy this property." Then you supply the contract of sale and all of the rental appraisals and everything like that, and then they would approve it based on the information you've supplied. Would that be the difference?
Exactly it. So we need to allow for leniency, especially when doing cash out, right? The intent is obviously what you do on the first application. We need to be very, very clear regarding that. And at times, depending if, for example, let's say a lender has tweaked their policies, even after you settled a loan and you then go back to saying, hey, actually, I want to use that cash out again, they do have the right to be like, we decided not to. And then at that time, you're like, so what do I do? And you've done all that and trying to take out equity and cash out for the purpose of flexibility. But really, they have all the power in doing that. And that's difficult. So that's really, really important. So uncontrolled versus controlled. Best thing to do, I want to take out equity, go to your bank and just be like, hey, is this controlled or uncontrolled? And again, timing is everything when it comes to cash outs. When I'm saying timing, do a valuation on your own properties now, all of it, right? Do desktop valuation, do CoreLogic vals, curbside, full vals, do whatever you need to do. Get valuations, understand, because cash out is going to be determined by, again, the valuation. If your valuation is high now and you decide in the future that you wanted to buy multiple properties, you have the income that you guys can do it now, fantastic. A nice little strategy, take the cash out now, park it, interest only, leave the money inside the offset account. You make no repayments. You tell the bank to keep it open. You have accessible funds when you need it, when you want to do it. And that's because obviously the valuation has been high during that time. Fast forward, you don't do that. Then you go, actually, I really want to buy an investment now. Fantastic. Another investment. That valuation drops a little bit, nothing too crazy. Let's say 30 grand, right? You go, okay, I want to take out equity now. Well, it's not as much as what you could have done, 3, 4, 5, 6 months ago. So just a thought.
I think
Okay.
it's worthwhile even noting that as soon as you go and start the process of going to multiple lenders for valuations, it is amazing how different they can be. So,
I mean, this is another topic in itself, you know
yeah, no, it's and look, like, I
that.
mean, I could do a whole webinar on valuations
Me
and
too.
valuers, but it is a really interesting one because ultimately, it's the difference between whether or not you can and can't do something a lot of times, whether or not you can get, 100K out, 150K out. It's the difference between whether you can buy again or not. So going to multiple lenders and getting multiple valuations is always key.
Yeah, I agree. Like, yeah, depending on which risk appetite which they want to go through, again, mixing policy with that and where the property is located, what type of property it is a big one too.
Mm,
What type of property is a big one.
mm,
I want to touch on self-employed and SMSF loans for a little bit right now. Just some interesting stuff for our self-employed brothers and sisters out there. This is something for you. So there's a lot of challenges with self-employed loans, depending on what you guys want to do. There's a lot of income verification difficulties. We know that, right? If your accountant doesn't know lending, it is very difficult to get lending. I'm just being really honest here, right? Like, make sure you understand that you have an accountant that understands lending to some capacity and that understands lending. If you are doing tax planning, right?
yeah.
You have tax planning, get your broker, if your broker is fantastic, to be involved in that same meeting.
Yeah, I
Yeah,
think
of
this is a like a massive thing for this time of the year. If
course.
you're intending to do, if you're self-employed right now, or a sole trader, you need to be having these conversations with your accountant and your broker at the same time because accountants are typically trying to save you money, aren't they? They're trying to say
No,
you didn't earn as
and
much
there's
as you
nothing
maybe
wrong
did
with
and
that.
things like that. Nothing wrong
Yeah,
with that.
nothing wrong with
But
that.
it's
Nothing wrong with that.
the only
Absolutely.
problem with that is when it does come down to the time you apply for a loan and you're presenting a tax return that says you didn't make any money last year. So make sure there is some planning in place with your accountant and your financial planner or your mortgage broker to ensure that you're actually showing a profit where possible so that you can actually get
Of
the funds.
course.
Really
And
good.
that's the biggest one because we're seeing, we do a lot of self-employed. I like to think myself as a kind of self-employed investor expert. And we are seeing right now saying if you're doing tax planning, like let us come to the meetings, let us sit down, let's talk about the
Mm,
plan, what that looks like, so we could then strategize collectively as a group, not just a singular person towards it. So again, income verification difficulties, inconsistent income streams, and then again, so some lenders are higher risk perception.
yeah.
So we'll just touch on that a little bit. So which one are you? Doc Goose. For the people that are into the podcast, we put it's Doc like DOC. Anyway, it's that joke. It is what it is. I'm so sorry. Cool. And what that is full doc, alt doc, or low doc. Yeah. What is full doc? What is alt doc? What is low doc? And even my opinions around those things now is different. So full doc requires everything. They're gonna check everything. If your company trust, they want to see everything. Yeah, you cannot shy away from it. They need NOAs, they need everything around you. Alt doc is just providing what they want to see, yeah, and trusting everything else is in order. I'll give you an example. Alt doc is just maybe say an ITR because you're a director of the company, but not having to show the CTR or not having to show the NOA. Yeah, that's an alternative. It's alternative documentation. You can provide what they want to see from their risk appetite and then do it. Low doc is basically you don't want to show anything, right? And depending on which bank you go through, usually non-bank lenders, they'll just say, well, I want an accountant's letter and I want an accountant's confirmation. Side point, a lot more accountants now are not wanting to go down low doc. Yeah.
Mm,
Before, the general consensus for accountants is like, yes, I'm happy to do it. But now it's going, a lot of them are starting to see it as credit advice. And you're going to see a lot more accountants doing a lot more pushback in the low doc sphere. Hence why, if you are self-employed, very important, or self-employed people, very important to collaborate with the accountant and the broker or the banker. And if they don't want to collaborate, they shouldn't be a broker or banker because they need to be. They need to be inside it. That's your team. They rock with you and they love you. Okay, cool.
mhm.
So that's full doc, alt doc, and low doc. And obviously, despite the challenges, there's still excellent options for self-employed individuals. I'll kind of go through what those are and what we are seeing to do that for income verification. Some policies that we're seeing that we're like, wow, that's actually really interesting. Just to give you an example what that looks like. Okay. But Bankwest again has been fairly good. I don't know what's going on with Bankwest. Like they've been really aggressive in changing their policies pretty aggressively. Obviously, they're still owned by CBA. We know that. I'm not sure why the risk appetite has been there. Anyways, a lot of their confirmation is just ITR. It doesn't need the ITR doesn't have to show a notice of assessment. They don't want to know
For
company
in layman terms, ITR income tax.
income tax return. My bad. Thank you, Tim. ITR stands for income tax return. Company CTR is company tax return, and NOA stands for notice of assessment. So a lot with for example Bankwest, they could take in ITR by itself, meaning if for example the company holds multiple debts. Perfect example, you have a company that holds Ford Rangers, trucks, all your liabilities, but the company still pays you, the director, 100 grand a year, ITR. Yeah. The CTR, the company tax returns won't be included. They can assess you based on what's called simple self-employed verification, which is just yourself as a director of that company without taking into liabilities of your other stuff. Whereas a full doc, as an example, is you submit the company tax returns. They will look at all your liabilities inside that company tax returns, which then results usually in a lower borrowing capacity. Yeah. They could say, well, we're going to add back depreciation or add back interest, but it's like, it's not big enough to support the cause for borrowing capacity, which is pretty cool. Another one has been good. ANZ 1 year tax returns. They've been fairly good for the last few years. Very, very consistent around that. NAB has been fairly good too. NAB before they were accepting draft ITRs, not even lodged. They were accepting draft at one time. They've changed that a little bit as of late, and that's I think because they were entering into the new financial year. That you shouldn't have draft at this stage. But if you do have drafts, and FYI, for the people that haven't done their returns yet, they're 23 returns, and you want to borrow, make sure you get a broker or a banker to help you out, because there are some lenders that will still take 23s, and that's a good thing too. Especially if you haven't lodged it, you could work out the numbers to make sure that it's sufficient for your tax planning and sufficient for your lending planning. All right, there you go. Again, you could cite here NAB director wages, and you could take, if you're paying yourself a salary, they could take that and accept that as PAYG. Same thing for a lot of it. I think there's been a lot more flexibility regarding the self-employed landscape, which is actually very interesting because you could argue that these self-employed policies are actually alternative documentation. Yeah, they're actually not full doc. In my opinion, they're not full doc, because if they're full doc, they'd be asking everything underneath the sun. But a lot of them are not at the moment. So they're asking for what it is. If you're self-employed, take advantage of that. And again, if you guys can see my screen, just a couple of comparisons. I could send these slides to you guys just to look see what that looks like. A perfect example of, say, Bankwest is you could do ITRs as long as it's not a draft ITR, like there's no words drafting on it, and they don't require a notice of assessment, no NOAs, and they'll just get a letter from your accountant saying that this has been lodged. That's enough for them to say that's good to go. All right, so that is that for self-employed. Self-employed in itself is a 4-hour conversation. For people that's self-employed that needs navigation, please just talk to me. I'll point you the right direction. SMSFs, they've been having it's on the rise. Lots of people are more aggressive with SMSF now, refinancing, purchasing in SMSFs. Obviously,
they seem to go in waves with self-managed super fund loans. They all exit and then they come running back. It's really interesting.
Yeah, well, look, like most of the big fours have exited. Actually, that's incorrect. Big fours have exited. Like they're not in SMSF territory. A lot of non-banks are in SMSF territory. And to be honest with you, like they specialize in it, so they understand what that looks like. And yeah, we deal with a lot of SMSFs. That's a big thing that we deal with at the moment, so we understand what that looks like. Yeah, fairly comfortable around the conversation. So again, SMSFs have certain requirements. If, for example, you decide to open up an SMSF, you can get actual pre-approval even before you open it up. Yeah, and this is interesting. Not a lot of people know that. There's lenders like Mezi that will give you an AIP in 3 minutes.
Approved in principle?
AIP, correct. So AIP is a nerdy version of saying pre-approval. So thank you, Tim. So AIP stands for approval in principle or pre-approval. So if, for example, you're like, well, I don't want to open up an SMSF yet. I don't know how much I could borrow or what I could do. Mezi could offer an AIP, an actual full certificate, full pre-approval for everything, based on income verification, and you can get that in 3 minutes before you open up the SMSF, so you know what you're looking at to buy.
Yeah.
Good for buyers, good to bring to buyers agents and be like, hey, this is roughly what I could do. This is the yield that I need, and that helps some planning whenever you're acquiring anything in SMSF, especially if you're using a buyer's agent too.
Man.
So some SMSF loans. These are some pretty
Mm.
interesting stuff that we're liking. So we got on the screen here. I just chose three. There's far more people that could do it, but I just chose three for now. Granite, Mortgage Mezi, and kind of Go Money, which is kind of think tank. Granite and Go Money, there's no liquidity requirement. That's really important. So if, for example, let's say your SMSF goes to $1 or nil,
Jeez,
some
that's I've
yeah,
never seen a loan like that for an
no
SMSF.
liquidity.
Yeah.
Yeah, so it is very, very common that we're seeing a lot more people that, especially like more aggressive investors, they're like, well, I want to be working for the next 20 or 30 years. I'm kind of comfortable with doing that. And I'm like, okay, well, that makes sense. You obviously get your advice regarding it, but there's no liquidity requirements to
Well,
do
not
that.
even to service the insurances or anything. I suppose the
No,
income going in has got to do that. Wow.
correct. Yeah, cool.
I'd be certainly having a chat with financial planners for recommendations on these ones, because
For sure. Yeah,
that's a
absolutely.
scary thought for me.
Yeah. So yeah,
Yeah.
no liquidity. Some of these has offset accounts, which is great. Which is I think is fantastic. Before there was really no offset accounts as such. Now you can get offset accounts. Some of this will go into 90% LVRs, right? Granite can do 90% LVRs now, which is pretty interesting. Obviously, as long as the income is there, you could support it. It's good. Whereas before, we only saw SMSFs in that 60, 70% LVR marks. You can go up
Mm.
to 90%, which is I think pretty good. You could do easy refinance solutions too. Usually SMSFs have pretty good records. Uh, there's easy refinances where you could move over to a lender without having to prove too much, except for the lending conduct. So no income verification, just lending conduct is good. They will move you over. Very easy refinance. And usually valuations are 60, 70% LVRs anyway.
Lucky,
So
just out of curiosity,
yeah,
what sort of rough rates are we looking
sevens, high
in the
sevens.
sevens? I mean,
Yeah,
that's
yeah,
pretty
cool.
competitive considering where residential, non-SMSF loans are at the moment.
Non-bank, you're paying the sevens now anyway.
Yeah, that's
Like
right.
you really are. Some people are requiring in the sevens, and it that's just what it is at the moment. Obviously, that's a sliding scale depending on where the LVR is,
Yeah.
but for the most part, that's it. But this is interesting as well. Go Money again, which is backed by think tank, it's pretty interesting. You could actually use 20% of annual income as super contribution with no proof,
Mm.
which is very interesting. So that you could then do that for a higher borrowing capacity. And again, there is no liquidity requirement. I think it's fantastic for people that want to get into the SMSF lending space or use that. And the good thing is, if you are maxed out in lending, and yes, you at one day you will be maxed out in lending, right?
We're 7 minutes
Love it.
to go. We better get to some
Oh,
questions shortly as
oh
well.
mate. Cool. All right. Well, I'm gonna go real quick, and I'm sorry, guys. There's so much questions, but
No, that's
I
fine.
could apologize. Private lending. What's private lending? Man, Tim, you got me fired up, man. Far out. Private lending is just for another security lend. So what that means is it's not for anything to do with income. It's just a security lend. What is that good for? It's good for people that the accountants don't want to sign off on letters, and they just want to do a pure security lend. Those rates start at kind of 8-9% annually. It's good to kind of get in and then kind of get out, especially if you have an acquisition. So flexibility, speed, and there is no requirements. It's just a pure security lend, right?
Yeah.
That's what's called private lending. There's two more things here that I'll go through, and then Tim, I don't have time for my thing at the end, but 100% lending with majors is a good one. We're seeing a lot more of this. I won't say which lenders, but 80%, you can go up to 80% on the home loan, and they'll do 20% as a business loan, effectively 100% lend. And the last one is we're seeing own home, and this is interesting now, right?
Mm.
So own home, you need 1.1% upfront cost. That is it.
Wait, we're talking about getting finance for your own property, first property.
Mhm. That's right, which is 100% borrowing. You only need 1.1% upfront. They say they pitch it as 100% borrowing, but really you need 1.1%. There's a fee inside there. Now, I like to see it as an LMI alternative, right? The marketing is 100% lend. It's an LMI alternative because effectively you are borrowing 80% from a lender. You're getting 20% from own home, but there's a fee to that. Yeah, which is effectively LMI. And there's a perfect example of what that looks like here, where own home would be cheaper than LMI. It is good for owner occupiers. Yeah, they're piloting investment products out there. We're actually been selected to pilot 100% lend for investment using an owner home product, and we're looking at now. We're just doing our due diligence at the moment to see what the savings can look like to then do it. Caveat on that, you need to understand though that there's two assessments. One is the bank and one is own home. It's not just like you've been approved by the bank, you have to go to us. Yeah. And guys, we've covered a lot of ground today. There was so much more, but like I think if you need me, you call me.
Yeah, I was about to say it's very difficult to
I am so sorry,
talk
guys.
about all the different loan products in 45 minutes. You've done really well to get as much as you need into that amount of time, but yeah, obviously still a lot in there, as you can see. So look, Lucky, we've got 4 minutes before we've got to wrap things up. Usually wouldn't mind going over a little bit, but I've got another meeting to get to. So let's fly through a couple. So look, I've got one here from Chris. It says, thanks, gents, for a really interesting session. Just wondering what options might be available for an established or off the plan Gold Coast apartment acquisition used for primarily short-term letting, say 48 weeks per annum, grossing around 100K, for example, on-site management, interest only, or P&I. Goes on and on. Gross income around 150K with salary sacrifice. Any thoughts would be grateful. It sounds like it's definitely worthwhile.
That's a full on. Yeah, that's okay. That's a full on scenario. Speak to me after, but I'll tell you right now, non-bank, and yes, we could take that in. The income verification is not your standardized understanding, but the situation is fairly straightforward from a non-bank lender, and we could talk about that. That's a very, very specific scenario.
Yeah. Look, we put into the chat Lucky's website, financebetter, it should be. Sorry.
That's okay.
Type that wrong.
And guys, I'm on IG, so just add me on Instagram and you can see my dancing and stuff. So
look, as I'm sure everyone can appreciate, Lucky's gone through a hell of a lot today, but there's so many different variables when it comes to your situation. So please obviously reach out and book a time to have a chat with Lucky, and I'm sure you won't regret spending the time to actually understand exactly what he can do for you. One more question. I'm retired. My allocation pension is 100 grand per year. I'd like to buy a property by 80% in investment property value. Is that possible?
Yes, 100%. We're doing one right now. If you're in pension, as long as you're getting distributions from that, usually we could justify it by ITR. It makes actually sense as an investment, as an exit strategy. And you could, even if you're of age, like a lot, if as an owner occupied, if you buy as an owner occupied, probably won't get a 30-year term. Investment, we've done people that's in their 70s that got a 30-year term as long as an investment. And so, yes, the answer is there's a product out there that can do it, usually based on your ITR, individual tax return.
Very good. Look, lots more questions in there. I will share those questions with Lucky so he can reach out and follow some of you guys up. But I just wanted to say thank you very much for everybody attending today. And Lucky, appreciate you. We'll get you back on again soon because I think we need to break this up into sections. We can dive really deep into some more pointy conversations about different products. Thank you very much, mate.
You.
Let's do it again soon. Thank you all.
All right, guys. Take care. See you guys.
Bye.